Good morning, everybody, and welcome to our webinar this morning on intergenerational wealth planning. What is it and why is it so important to you? Before I go any further, I just want to cover a few housekeeping points. This webinar will last for half an hour. There'll be 5 minutes for questions at the end. By all means, ask questions as you go along by entering them in the box in the bottom right-hand corner of your screen. If we don't have time to answer your questions, we will follow up by email and or phone. Copies of the slides will be sent to you after the webinar, and your feedback on it will be most welcome. So as you can see, these are the housekeeping points we've just run through. So here's an image which conjures up what we mean by what I've labelled the intergenerations. There's so many generations now alive because we're all living so long that the advent of not only grandparents, children and grandchildren is here, but also great-grandchildren and great-grandparents is going to become more and more of a common phenomenon going forward. Intergenerational wealth management is about how families use their collective wealth to support each other during their lifetimes. Why do you need to plan for this? Well, increasing life expectancy and major social change mean many families need to reconsider how their wealth can work harder for the benefit of the whole family. We're now witnessing a phenomenon where the baby boomers, those born in the post-war era and approaching retirement, represent the wealthiest generation in our society. However, whilst they enjoy the fruits of their labour, they are sandwiched between elderly parents facing the challenges of old age and children struggling with the hangover of university debts and spiralling house prices. So, we're having a few problems with our slides this morning. Forgive us for the slight delays. So, challenging the norm. Traditionally, wealth is passed from one generation to the next upon death. However, intergenerational wealth management challenges that notion and looks at how families can use their wealth more collaboratively to support each other during their lifetimes. This offers legitimate estate planning and tax mitigation opportunities, whilst providing a much-needed assistance to alleviate the financial burdens of everyday life. Stretching retirement income across generations. A study by St James's Place into intergenerational wealth and retirement planning has revealed that the number of families with multiple generations in retirement at the same time would exceed 1 million in the next 20 years. This means people may need to start reassessing how they plan for the later stages of life. I recently was introduced by a client of ours who's aged 93 to his two sons who are already both retired, and they themselves are grandfathers. So, as I said earlier, this is going to be a common phenomenon going forward, which is why the game has completely changed. Now, I couldn't help myself but to put in this saying, talking about my generation, for those of you old enough to remember The Who. Unfortunately, it's a US slide, so the terms aren't 100% as identical to us, but it does show the different generations. In fact, I did a bit of research. There's about 10 generations that go back even further. We only really tend to concentrate on baby boomers that we know of, typically aged up to about 40. Millennials aged up to 40, roughly, and baby boomers typically born after the Second World War up until 1964. But there's an even older generation. The US call it the GI generation, but here in the UK we call it the greatest generation. But there are even further generations that go further back, and now there's a new generation that's come in after the Generation Z in the top left. There's now an alpha generation, believe it or not. So there's a real alphabet soup of generations. All very interesting. So let's move on. So the interesting thing here is that baby boomers now represent the wealthiest generation in history. And I'm one of them, and so are many of my clients, many of our clients. We're likely to remain the wealthiest generation until about 2030, but there is a staggering amount of wealth that's going to pass from us baby boomers to millennials. 5.5 trillion pounds worth of wealth is going to pass to millennials between 2020 and 2047. Now, millennials, we commonly felt of as hard done by. They're taking a long time to get on the housing ladder. They're having to put up with basically funding a lot more provision for elderly people in the form of public sector and state pensions, which are, of course, not funded. These are on a pay-as-you-go basis, so millennials are getting a bad deal there. But in fact, contrary to popular opinion, millennials are going to inherit so much wealth that they are going to become even wealthier, as I mentioned, than the baby boomers. So don't worry about your millennial children or grandchildren. They're going to be just fine. Because of increasing life expectancy, multiple generations of families are increasingly going to coexist, as I mentioned just now. And in fact, due to longevity, the percentage of the population aged 65 plus is expected to grow to 1 in 4 people by 2050, compared to 1 in 5 in 2018. Main reasons for this are improvements in healthcare and a declining birth rate. So, intergenerational issues for parents, assisting aging parents with the financial decision making, discussions on the subject of death and who stands to inherit the parental estate, concerns over who looks after the parents if they lose mental capacity, funding any required care, whether at home or at a residential facility, reviewing existing investments, pensions and other plans to check continuing suitability, especially if a trusted advisor has retired or otherwise been replaced. So here's a typical image of a care home. My father was in one. He had Alzheimer's, unfortunately, for 7 years. And we had to, obviously, well, didn't have to. We wanted to visit him weekly. My mother visited him 3 times a week. And it's a typical scene. So we talked about parents, intergenerational issues. Now it's generational issues for children or grandchildren. The key things here are making sure children are saving enough for their future, school and university fee planning for children or grandchildren, helping the younger generations to buy their first property, educating the younger generations on the savings options available to them, making them aware of how much they can expect to generate from a certain level of input, and providing financial support for younger children in the event of parental death. So student debt, as we all know, is a big problem. I have 3 millennial children. They've all got student debt, but they seem remarkably relaxed about it. I don't understand why, because it's still a debt. And the terms of these debts have got increasingly worse since the student loan company was sold. Interest rates have gone up, and it's a real debt to be paid off. It's not a small amount of debt anymore, or a low interest rate. And this level of debt is increasing with every successive student year of entry, I feel. The last time I estimated it was about £55,000, a typical student debt at the end of a 3-year degree, not to be sniffed at. So the issue here is the transferring of wealth. So increasingly, baby boomers and their parents, the silent generation or the generation before that, the greatest generation, are transferring more of their wealth to their dependents during their lifetime, rather than leaving 100% of it to them when they die. And it's on the basis that loved ones need the money now, not when they themselves are already retired. The reason this is important, when you think about it, with much extended generations, you don't want to be inheriting money when you're 70, because you'll already be retired yourself. why not gift money to children when they need it most? I've personally gifted money to all three of my millennial children, not to give them the whole deposit on their houses, but to give them a leg up to contribute towards their deposits on their properties. I thought that made sense, and they appreciated it. So some examples of helping the younger generation would be things like I've just mentioned, paying off student debt, gifting money to children or grandchildren to put down a deposit of buying a house, helping a son or daughter going through a divorce, business failure or redundancy. Another purpose may purely just be to help them build wealth while you're reducing your own estate for inheritance tax purposes. So there are many ways to pass wealth to the next generation, but it's important to do it in the most tax efficient manner possible, because believe you me, there are many traps for the unwary. We study this subject full time, and yet there's still areas of learning that even we have to do on a regular basis. So it's very difficult for the ordinary person in the street to keep on top of the huge complexity of taxes, for example. So you'll be all aware of this image, Bank of Mum and Dad. Apparently, the Bank of Mum and Dad, which of course doesn't actually exist, but if you were to rank it in terms of the lenders in the UK, it would rank as one of the top 10 mortgage lenders. Can you believe it? So what I've done here is I've produced a little list of what I've described as tax efficient wealth transfer best practice. Now, I think this is one of the most valuable slides you'll read here. And remember, you'll get copies of these slides after the presentation today. There are countless tax-efficient strategies for transferring wealth, too numerous to cover in a short webinar like this. But if you follow the general guidance below, you'll maximize the likelihood of getting it right. Now, this is a saying we use a lot in the office here. Don't let the tax tail wag the investment dog. What does that mean? What it means is don't invest purely for tax reasons. The underlying investment has to stack up in its own right first. If a tax-efficient wrapper can be added to it, such as an ISA or pension, then so much the better. Ensure you take advice from a tax specialist and/or a financial planner who specialises in tax-efficient wealth management. There are many advisors out there, but they all got different specialisms. One might be a mortgage specialist, one might be a group scheme specialist, one might be, I don't know, a final salary pension specialist. You can't be all things to all men. When this is such a complex area, do go to the people that have got the proven expertise and experience and are trusted. Maximise the tax allowances and reliefs that are available. There are literally thousands available, and I kid you not. Just do a Google search on HMRC, use the words tax allowances and reliefs. You'll be staggered what's available. Be clear about your objectives before gifting money or assets away. That's pretty critical. It's so easy to just spend money and give money away. Be very smart how you do it. So the next one's quite important. I won't give the person's name away, but I've known people who I know very well who've been incredibly generous. But guess what they've done? They've made themselves poor as a result. So don't create an own goal by worsening your own financial situation or the transferee's financial position, because that could happen too. It may be you're worsening someone else's position by just being too generous. I've known clients buy whole houses for their children. Now, of course, they can afford to do it, but I'm not entirely convinced it's a good idea to be over generous, particularly the younger the children, because I don't think young adults generally would appreciate it given too much for free. And as we all know, the old saying, people don't value anything they get for free. So giving your relatives, younger relatives, a leg up or some help, I think it's a good idea, but don't be over generous until they're older and they've really established themselves and only give when they really need the money, or their children need the money, I would suggest. But it's your money at the end of the day, your decision. By all means, listen to the advice of a friend. I've put that in inverted commas for a reason. I've so often heard of clients or their acquaintances talking to a friend in the pub or a relative, and decided to do something based on what they said. But I'm not being disrespectful. Now, you may trust that person and they may have your best interests at heart, but bless them, they haven't got a clue. Unless they are experts, you don't know what you're dropping yourself into. We've had clients, for example, gift money, gift property in part or in full to children, like their own property, for example, gift it to the children. Nobody told them that meant the property was subject to capital gains tax when they sold it, for example, or that it didn't solve their inheritance tax issue because it remains part of their estate because they're still enjoying the benefit. So you'd be amazed at how much you don't know. You really don't know what you don't know. And that's not meant to be disrespectful or patronising. It's just a very specialist area. So check it out with a trusted professional advisor who knows his or her subject and genuinely has your best interest at heart. And I do believe sincerely that the vast majority of independent financial advisors in this country are good people, honest, they do have your best interests at heart. And we're talking about the boutique size firms, the small firms. Many of these advisors spent their lifetime building their business, building trust, and they've got long-standing clients of 20, 30 years duration or more. Those people have survived a very difficult regulatory regime, and they've survived because they're honest and trustworthy, have not been put out of business. Last but not least, be prepared to pay for high quality advice. You really do get what you pay for. So, some of the main tax rules regarding intergenerational gifting, I've divided this into 3 taxes, the 3 principal taxes that would affect you as an individual. And I'm gearing this towards gifting to your relatives. So inheritance tax. Gifts to descendants or parents and grandparents are normally known as pets, not to be confused with your dog and cat in your house. This means a potentially exempt transfer. So if you give money away or give an asset away, you have to survive 7 years before that gift is fully outside your estate for inheritance tax purposes. Now, there is something known as tapering, and without boring you about the subject, basically, as from year 3 onwards, gradually less and less of that gift remains in your estate. That's all you need to know at this stage. There are various little gift exemptions that have survived since the year dot. They never increased these. When I first studied tax, when in my early 20s, the same amounts applied. You couldn't make it up. They've not been inflation proof. I've listed a few gifts there that are inheritance tax free. There's also a rule which I don't think is used enough, and probably because most people aren't aware of it, but there's a normal expenditure out of income rule. So basically, if you are able to gift money annually or monthly out of your income, and it doesn't diminish your lifestyle, your standard of living, and especially if it's a high income, you could potentially gift much larger sums, and they could be free of inheritance tax. They don't need to be covered by any of these gift exemptions. Now, it's not, how can I put this? It's a bit of a grey area. You need to speak to a tax specialist to be sure. And even a tax specialist probably couldn't 100% guarantee it would be accepted. But as long as you follow the general rule, this should be something you can do. And it's very clever inheritance tax planning, can be very, very valuable to you. Gifts into most trusts are known as what's called as chargeable lifetime transfers. In other words, they're subject to inheritance tax during your lifetime. So be aware of that. What would happen is they would be taxed at 50% of the normal 40% inheritance tax rate. So still a 20% tax bill during your lifetime. That's something that could catch you out if you wasn't aware of it. Most people don't get caught by this because most people make gifts below what their own individual, what's called nil rate band, which is their own inheritance tax exemption of £325,000 per person. The other little trap people can get caught out in is if you have made a previous gift in the previous 7 years, which failed as a pet, then that will be added to the other 7 years. So potentially it could be 14 years you're looking back at. So again, important to take advice. So do you know the tax implications of gifting? This covers all three taxes, by the way. So capital gains tax, some very interesting points here. Gifts to descendants or parents and grandparents usually subject to capital gains tax if they're assets that are normally subject to capital gains tax when sold. Most people are not aware of this. So you could trigger a capital gain without even realizing it. The gift is treated as a sale at the value on the date of gift, and the value is the market value. So if it's shares, it's obvious what the value was, but if it's a property, for example, you need to get a valuation. And most of these non-cash gifts are for property or shares. The annual tax-free limit for capital gains tax is $12,300, available for each donor. So husband and wife, that's combined $24,600 a year. Also, gifts into discretionary or interest in possession trusts will usually benefit from something known as holdover relief. So what this means is that the taxation on the capital gain may be deferred until that asset is sold in the trust, which could be many, many years later. And interestingly, gifts to minors, in other words, children under the age of 18, enable your minor children or grandchildren to use their own capital gains tax exemption of $12,300 each, without the parents suffering any capital gains tax consequences. I think that's a very underused tax exemption there. Extraordinary to think that someone aged 1 could have their own capital gains tax exemption, but it's true. And last but not least, income tax. Gifts to individuals are not usually subject to income tax, but there's an interesting rule here. If a parent gifts money to a minor unmarried child, they don't avoid income tax, because this is something a high rate taxpayer might do. They might think, well, rather than have the money in my account and pay high rate tax, I'll gift it to my child, thinking there'll be no income tax to pay. But just watch out. If the income from that gift is more than £100 a year, then it will be taxed on the parent as if it was as though it was the parent's income. Interestingly, capital gains tax doesn't apply, as I said on the last slide, so children can use their own capital gains tax exemption. Doesn't apply to income tax, so just be aware of that. The other thing is that this rule doesn't apply to gifts by grandparents or other relatives or friends, only to funds gifted by parents. Now, for any of you who own an investment bond, which is an investment, but technically it's treated by HMRC as a life insurance policy. It is, to all intents and purposes, just an investment, but covered by life insurance legislation, tax legislation. If you gift parts of your investment bond or the whole investment bond, for example, from parent to children, then it doesn't trigger a tax event. It doesn't become subject to tax and become what's called a chargeable event. Now, don't get confused with capital gains. This is a chargeable gain, not a capital gain, so it's subject to income tax. But if you gift a bond or segments of that bond, for example, from parent to child, no tax charge applies on that gift. Very, very useful, I find. So wills and lasting powers of attorney, next subject to cover. These are very vital, in my opinion. So I thought, rather than tell you something you already know, we all know what wills are, I thought I'd give you a few useful tips that you don't always, especially if you do it yourself, you wouldn't always be aware of necessarily. We've all heard of these W.H. Smith wills that you can buy. I don't know if they still sell them, by the way. I haven't been to W.H. Smith for some time, but you can buy these wills and do it yourself. Well, it's legendary how many people have created their own will and made the basic mistake of not getting two independent people present to witness the will when they signed it. An elementary mistake, but very easy to make. This next one, I think, is vitally important. Store your will with a will writing company for a nominal annual fee, such as the local will company in Northampton. It's actually called the Will Company. They don't charge a very high fee. It's only about £25, maybe £30 a year to store your will. Now, you may think that's a lot of money for storage, but it doesn't stop there. What you can do is you can also store other valuable documents for free, such as lasting powers of attorney and house deeds or whatever. But on top of that, they will allow you to have 3 free will rewrites a year. Now, Admittedly, none of our clients have ever had 3 will rewrites a year. But I've had 2 in the last 12 months myself, and I think that's incredibly valuable. So I think the security of having it stored securely, I think alone is worth its weight in gold, because if you can't find your will, if your beneficiary can't find your will on death, then you haven't got a will. So it's vital to have it there, and particularly when you get older, what could happen? You might end up with dementia, forgot where you put your will. What if your children can't find it? So I think it's not worth the risk of storing it at home, because you've got a fire risk, you've got a theft risk, you've got a loss of memory risk. It's just not worth it for such an infinitesimally low fee every year. Get it stored by a will company. By the way, solicitors don't, in my experience, offer this service. I think they're missing a big, big trick. Now, support your will with a letter of wishes to detail all the little small items that would make the will such a long document. I mean, there are wills historically that have gone to, wait for this, 10, 12, 15, 20 pages long, where the individuals try to list every single little possession they own. It makes no sense. Just put your main wishes in your will and then support it with a letter of wishes. The letter of wishes can be updated daily if you wish. It's not legally enforceable, but it's highly persuasive, and woe betide an executor that doesn't follow the wishes of the letter of wishes. Put all your detail in there. You're going to be constantly buying and selling things, and it needs updating. You don't want to be changing your will every 5 minutes, do you? There's something else which isn't used by many companies in my experience, and I don't know any solicitors who use this. We use something known as death checklists. It sounds very grim. Let's face it, death isn't a very exciting subject to talk about, but hey, we're all going to die one day. Let's be real about this. So there are various death checklists to detail where everything is and where to find it. It's far better than your grandfather or grandmother writing down a piece of paper, forgetting where they put it. You know, you could spend months hunting through their house after they died trying to find this. Have a proper death checklist and let people know where it's kept. We have 3 standard death checklists. A bit of an overkill, forgive the pun, but we think that's a vitally good service to have. And last but not least, this is one that's slipping by many, many people when they die. Don't forget to give your login details to your loved ones for your computers and devices in order to access your IT records and favourite websites, including your social media sites and email accounts. Nothing worse than going onto social media and finding a friend or relative of yours died months ago and their account is still open. I mean, it's so embarrassing. It's untrue. So do keep a record of that somewhere safe, which everyone knows where it is. Now, always seek advice before making large gifts. And what do we mean by large gifts? Well, I suppose it's all relative, but I think you know what I'm getting at. If it's a large gift, particularly above those exemption levels I gave you earlier, those small gift exemptions and the 3,000 a year allowance and normal expenditure out of income, I think you get the idea. Probably gifts in excess of 10, 20 grand would count as large gifts. Now, next section, tax efficient gifting to minors. The junior ISA limit was only £4,368 a year up until last year, but there's been a huge increase in it to £9,000. So parents can gift money into junior ISAs for their minor children, which makes them free of income tax and capital gains tax. So such payments immediately come out of the donor's estate if using an exemption, such as the potentially exempt transfer exemption. But more importantly, friends and families can gift money into the junior ISA once it's been set up by parents or legal guardians. The only downside is when your child turns 18, they get full access to the account. But hopefully you'll have taught them to be sensible with their money, and they'll put it towards their university costs or get on the property ladder with the money and not go out and blow it on a Ferrari. You can also pay up to £2,880 a year into a pension on behalf of a child. It doesn't have a term like junior ISA, but you might as well call it a junior pension, I suppose, for want of a better description. Beauty of this is that your child gets tax relief on a pension. Could you believe it? So you pay 2,880 in the year, and the government, thank you very much, will add 20%, which is £720, which means they're boosting the value of it by 25% overnight. Now, a parent or guardian needs to open the pension, but other people can contribute, such as other relatives and friends if they wished. Control of the pension passes to the child when they reach age 18, but they can't touch it until they reach 55. In practice, it's going to be 57 and probably older. So you've got to bear it in mind against that disadvantage. I was speaking to a new client only yesterday, and they've got children who are minors. They made it clear they didn't want to leave to give them too much money when they're 18. So I put the idea to them of a junior pension because they're going to have to wait longer for the money. So they're considering that at the moment. Now, this is quite an interesting one. There's a lot of wording on the screen. I'm not going to read everything out because of time limits, but just be aware that anybody can pay money into a pension for anybody else. Most people aren't aware of this rule. So a classic situation might be a parent gifting money into, say, an adult child's pension scheme. For example, I could pay money into a pension scheme for one of my adult children. I could pay, say, 20 grand in. That's the end. Once I pay the 20 grand, all the tax relief goes to my child, my adult child. They can claim higher rate tax relief back as well. The gift I make is a gift for inheritance tax purposes, so it would be subject to this potentially exempt transfer regime. So up to 7 years it falls outside my estate. I could cover it with some of the other exemptions I mentioned earlier in part. Maybe I could argue it's normal expenditure out of income. Again, it would have to pass the HMRC test. The other interesting thing, if any of you got adult children who are fortunate or unfortunate enough for one or both of them, the child and their adult child and their spouse, for example, to be earning money in the region of 50 to 60,000 a year, and they've got children, well, their child benefit gets phased out and it reduces to zero on 60,000 a year. Well, if you paid, say, 10 grand into a pension for them, that would reduce their income from 60 to 50,000 pounds, and hey presto, the child benefit, instead of being lost, is fully retained. So very useful thing to use third-party pension contributions. And this is some other benefits of it. For example, if you as an individual have used up your own limits because you pay too much into your pension, you're above the annual allowance, or you're over 75 and can't pay any more, you can pay it into your children's pension instead. So that could reduce your inheritance tax bill in the future and build up their pensions more. So we think that's a really, really useful relief, and one that you should take advice on if you feel that way inclined to gift more money to children. Why not gift it in the most tax efficient manner possible into a pension scheme? Pension gifting on death. Now, again, because of the time constraints, I'm not going to read every word, but just to say to you that just be aware that if you have a personal pension or what's called a money purchase pension, not a final salary pension scheme, when you die, the money can be paid out to your children as a lump sum. For example, if it's going to children or to a spouse. But what you could do instead is you could have the pension inherited by them, so that the money doesn't get paid out of the pension. They become the new pension scheme member. And the benefit of that is several-fold. So, for example, it doesn't form part of their estate for inheritance tax purposes. So you're not creating an inheritance tax burden for them. If the parent dies before 75, then the whole pot remains free of all taxes forever. So the beneficiary can draw on that whenever they like, and the money that's sat in a pension doesn't form part of their estate. totally tax-free. So that's quite a benefit. If the deceased dies after 75, then it doesn't become fully free of all taxes. It becomes subject to income tax only on any withdrawals. But whether you die before or after 75, the pension remains totally free of inheritance tax and outside the beneficiaries of the estate if it's inherited. So we think that's a major benefit. Another big benefit is that if you're fortunate or unfortunate enough to have a very large pension above this weird figure of 1,073,100, known as the lifetime allowance, then usually further tax charges apply when benefits are taken above that level. But if you inherit a pension, the inherited value of that pension doesn't get added to your other pensions for the lifetime allowance. So that is a huge benefit. And I think it is an HMRC legislation drafting error, because I can't for 1 minute think the HMRC would ever be that generous. So the message is that if you're a beneficiary of a money purchase pension, it's usually better for you to elect to keep the funds within the pension wrapper rather than accept the death benefits as a cash lump sum, unless exceptionally your circumstances dictate you should opt for a lump sum payout. As we say here, best to take professional advice as ever. Discussion of family wealth with your relatives. Now, this slide, I'm afraid, is a little bit unclear, but I can read it out to you. The red, you can see the red even if you can't read the wording. All you need to know is that it's less than 50%. So under all these different circumstances, distribution of assets upon passing away, assets already gifted during lifetime, philanthropic commitments, family values and principles, they're all discussed less than 50% of the time with your family. Very important to discuss your wealth with your family and what you're intending to do with it. As mentioned here, it's something some clients are more sensitive about than others. Some are happy to disclose everything, some don't want to disclose anything. It's best to get it out in the open, I would suggest. Tell your family members what you're planning to do, what your wealth is, if you feel comfortable about telling them the exact amount, or just give them an idea and let them know what your decision has been made. Saves a lot of problems later, because wills can be disputed later and changed after death, and we don't really want that situation to ever apply. So we encourage clients to introduce us to their other family members, parents or children, and we want to get to know them, and we welcome it, whether it's just to get to know just by a welcome phone call or video conference call, or they may in fact wish to become clients of ours. But the earlier we build a relationship with your relatives, particularly your children and your grandparents, the better, because then we can help them in later life when unfortunately you eventually pass away. So what are we doing about it? Well, we advise all clients to arrange up-to-date tax-efficient wills and both of the types of lasting power of attorney. We encourage clients to make their children executors, trustees and attorneys. We produce a lot of educational content, which is all listed here. We'll even accept relatives such as adult children as family member clients, even if they don't meet our own minimum investment qualification criteria in their own right. So we really do want to welcome you to get to know us, even if it's just an introductory call. That's what we're doing. Next steps. We're offering a complimentary financial review meeting for up to an hour worth £470 to all family members referred to us. You're welcome to visit us anyway with existing clients if you're a family member. We would encourage you to go on our mailing list because we don't bombard you with offers. What we do is give you regular educational content, including this subject, intergenerational wealth planning, as a freebie for today, for thanking you for attending. You can have a complimentary copy of our 97 Money Gems e-booklet worth £3.97 if you're a family member. We've also got, believe it or not, a sister website geared towards the millennial generation called Wealth Magic, and there's a few other resources on that site. So if you've got any questions, I'm happy to answer them now. Sorry I've ran a little bit over. I'm 10 minutes over. My colleague here is going to tell me if there are any questions that have popped up. We're just checking that now for you. If you just bear with me a moment. While we wait to see if there are any questions, I'd just like to thank you for your time today and your patience. I hate overrunning, but I've gone overboard by 10 minutes today. Are there any questions? It doesn't look like we've got any questions today. I've either bored you silly or I've warned you into submission today, whatever. I think what almost certainly will happen after this webinar, you'll probably think of some questions after the event. So by all means, we'll be happy to accept a phone call or an email, whichever format you want it in. By all means, do ask us questions. There's bound to be questions you want to ask. Don't forget, you will be receiving copies of the presentation and the slides, and you'll be asked to give us feedback. It would be appreciated if you could. And thank you very much for attending today. And I wish you well. Stay safe, stay healthy, and see you before long. Bye for now.